Coming out of the pandemic shutdown lit the match for housing demand, and it's been burning hot for nearly 2 years straight, but a housing correction is finally on the horizon. 2/3 of the nation's largest housing markets are overvalued, according to a report by Moody Analytics, an economic research firm regarding risk, performance, and financial modeling. The report found that 210 metro areas were overvalued by 25% or more. Within that stat are 10 Michigan markets. The report determined overvaluation by comparing house prices and per capita wage and salary income, based on the 2020 census. House prices that exceed their fundamental value by more than 20% are considered extremely overvalued. Moody's Analytics Deputy Chief Economist Chris DeRitis is hesitant to call it a housing bubble, though. Instead, he prefers a housing correction. A bubble, for me, implies a big pop, he said. We are assuming that we have overvaluation. Home prices are going to slow, but incomes are then going to slowly increase over time, and kind of catch up with house prices. And that's how this whole thing resolves. In this video, we are going to discuss what homeowners, buyers, and sellers should know about the upcoming real estate crash. So, let's go to the video. Assuming the economy continues to slow but not dip into a recession, here's what DeRitis expects for homeowners, buyers and sellers. Homeowners. When news broke of home buyers going and waiving cash offers over asking prices, there was a pit in the stomach of those who lived through the housing crisis just a decade prior. Houses were moving quickly as pent-up pandemic demand met historically low mortgage rates under 3%. Many feared millennial buyers, who made up 43% of home buyers, would end up house poor coming out of bidding wars with a dozen other prospective buyers. However, DeRitis doesn't think that will be the case for most. A key factor separating the current market from the 2008 bubble are the lessons learned with subprime lending, DeRitis said. Buying in 2020 was still a good deal for the home buyer who was looking for a starter home. They plan to stay in for several years, DeRitis said. Not to mention they avoided the surge in rent prices that happened as a ripple effect. You shouldn't worry about the year-to-year fluctuations, he said. Even if prices go down 5% for their neighborhood properties, that shouldn't really concern them too much, because the long-term trends are still very positive. Those who bought in the last 6 months may be more at risk, considering they bought in what now looks like the peak of home prices, and they don't have as much of a buffer in home appreciation over time. Home flippers may be more vulnerable in this market, for the same reason, DeRitis said. Still, if a home buyer didn't overstretch their budget to begin with, DeRitis said they should be in the clear. Buyers. Current buyers may feel like they're stuck between a rock and a hard place when it comes to getting into the market now, or waiting for the correction. Timing the market is always a risk, but buyers now can afford to wait and shop around. High prices and higher mortgage rates have slowed down the pace of how long houses stay on the market, which opens up supply. The slowdown is healthy, DeRitis said, because it counteracts some of the behaviors that were popping up, like waiving appraisals or inspections. You don't have to be as impulsive, DeRitis said. You're going to have a lot more leverage in terms of the negotiation. You can put in those clauses, because you're not going to be competing with nearly as many buyers or potential buyers as you did in the past. Sellers. July's national home sale data showed downward trends across the board. New home sales showed a 30% decrease year-over-year, according to Realtor.com. This follows 6 months of declining existing home sales, and 5 months of declining housing starts. Nationally, 1.26 million homes were available at the beginning of July. This is equivalent to a 3-month supply, according to the National Association of Realtors. Historically, a 5 to 6 month supply is considered balanced in the real estate sector. Higher than a 6-month supply indicates a buyer's market, and lower indicates a seller's market. The slowing down in new house sales in particular has economists calling the current period a housing recession. The most recent builders' sentiment solidified that fear in August. The National Association of Home Builders Wells Fargo Housing Market Index dropped 6 points in August to 49. Anything below 50 is considered negative. Sellers should take note and adjust their expectations, DeRitta said. I think it's pretty clear that the sellers have to have realistic expectations, he said. This idea of listing your home on a Thursday, selling it by Sunday with 5 different competing offers with escalation clauses, having your pickup bids. I think you need to reset. In this video, we discussed what homeowners, buyers, and sellers should know about the upcoming real estate crash. If you got this video helpful, please give a thumbs up to the video. Don't forget to share this with your friends. Subscribe to the channel for more important videos like this. Thanks for watching.